Good afternoon. My name is Sarah Briant, and I am a Client Service Associate for the Greenville office of Ronald Blue Trust. It is my pleasure to welcome you to Investing Fundamentals for Women. Today, we have friends joining us from across the country. We appreciate you taking the time to join us, and we hope that you walk away from this webinar with a deeper understanding of personal finance and investing. A few housekeeping tips. If you look at the bottom of the screen, you will see there is an option to ask questions. We wholeheartedly encourage any questions that you may have during our time together, which Sherri will address and answer at the end of her presentation. Please feel free to ask questions as they arise, to go ahead and input them into Zoom, as I will be monitoring them and will provide a questions list to Sherri. Before I introduce our speaker, I'd like to take this time to thank Grace Church and their staff for graciously allowing us to stream our webinar from their facility. Thank you for all the assistance that you've provided to us for the past month and a half as we've prepared for today. Now, for our speaker, Sherri White. Sherri White is a Senior Private Wealth Advisor for the Private Wealth Division of Ronald Blue Trust and serves her clients out of the office in Greenville, South Carolina. Prior to joining Ronald Blue Trust, Sherri was a senior advisor and member of the leadership team at Plan First. Sherri graduated from Wake Forest University with a Bachelor of Science in Accounting. She is a certified public accountant, personal finance specialist, and a certified Kingdom advisor. As an active member of the community, Sherri is a board member of the Greenville chapter of the Accounting and Financial Women's Alliance and a member of the American Institute of CPAs and the South Carolina Association of CPAs. On a personal note, Sherri and her husband Jeff are also regular members at marriage retreats and other events where they're able to encourage couples and individuals on their stewardship journey. She has a heart to help women gain knowledge regarding personal finances. Jeff and Sherri have one daughter and live in Greenville, South Carolina. Please help me welcome Sherri White.
Thank you, Sarah. Appreciate that. And welcome to everyone who's joining us today. We're so excited that you're able to be with us for Investing Fundamentals for Women. Today in our time together, we're going to be talking about what I call the building blocks of investments. We're going to talk about what is a stock, what is a bond, what are mutual funds, and how do you put them all together to build an appropriate investment strategy for your personal goals. Now, I will tell you up front, I tend to be a little bit passionate about this particular topic and love the opportunity to speak about it because of my own personal experience. Many years ago, when I graduated from college and had my first real job here in Greenville, South Carolina with one of the large international accounting firms, I felt pretty good about myself. You know, I had my degree in accounting. I had just passed the CPA exam. You know, I was ready to take on the world and handle my own affairs. Felt like I was a pretty intelligent young woman until I got to work and the HR department handed me this packet. And there was all the information about the 401k plan. And I looked at that and realized I knew absolutely nothing about it. I had no idea what to do with it. And to be honest, for the first 2 to 3 years that I was working, I did not even participate in my 401k. I just kept putting it to the side, like, I'll think about that later. I'll think about that later. Now, fortunately, a few years later, we had a family friend who was in this industry who sat me down and explained what I needed to do and got me on the right path. And then, ironically enough, a few years later, after that, I actually entered this field as my full-time profession. Now, one of the things I've realized in the last 20 years in personal financial planning is that my experience is not unique. I've run across so many people who find when it comes to investing, they just don't feel as confident or comfortable with the arena as they'd really like to. And often they feel like I did, that there's some reason they should know more than they do. And so it makes them hesitant to enter into this area or even ask questions about it. But if you think about it, why should you know about investments? It's not like there's a primer course in high school or even in college that teaches you about this. For most families, it's not the topic at dinner table conversation. And even today with the internet, if you go out and try to Google it and get the information, what happens is information overload. It's more than you can handle and often conflicting information. So it doesn't leave you in a much better position than you were to start with. So with that backdrop in mind, our purpose today is to demystify investing a little bit. Don't want anyone feeling like I did when I started my job of looking at that saying, I just can't even go there. It's too much. And for those of you that maybe you do have some of these building blocks and the basics down already, Hopefully today you'll pick up some illustrations or some examples that you can use to then help your nieces and your daughters and your granddaughters and your friends or sisters who may not feel as comfortable as you do. You can help them come along. So with that, let's go ahead and get started. There we go. Our first slide has to be obviously our disclaimer. We are not giving specific investment advice today. This is completely educational in nature. Even when we get to the Q&A session at the end, we're just going to be approaching this from a very educational perspective. Individual advice has to be just that, individual, speaking about your personal situation. So I'd like to start with, what is the purpose of investing? Why do we even do this to start with? And unfortunately, investing is not like wandering around in this beautiful field that you see in the picture, just kind of wandering around and seeing where you end up and enjoying the journey. Investing really has to be done with a purpose. You have to have a plan. It has to be intentional in order to get where you want to be and to be a good steward of what you're trying to work with. So let's begin with the definition that we feel like is a really good way to look at why we invest to begin with. And I'm going to read this to you, and then we're going to drill down into the words that are underlined on the screen. So the ultimate purpose of investing is to preserve and grow capital through a well-built portfolio of investments so sufficient money is available when you need it. Now, that first word that's underlined, preserve, for most of us, when we hear that word, the first thing that we think about is protect. Protect in the sense that if I have $5,000 today, I want to put it aside, and if I come back 5 years later, I still want my $5,000. I don't want it to go anywhere. But in the investing world, that's really not what we mean. We're not talking about protecting the dollar amount. We're talking about protecting and preserving what you can buy with that dollar amount. We're talking about your purchasing power. So the idea is, if I've got $5,000 today, whatever I can buy with that $5,000, 5 years from now, I still want to be able to buy those same things with it. Now, we all know that the price of things goes up over time. And I'm going to use an example that unfortunately is not very relevant at the moment, and that is movie tickets. Nobody can go to the movies right now. But I'm hopeful. I'm believing that someday soon we'll be able to go back to the movies. But I do remember a day when you could get a movie ticket for $5. Some of you may remember when it was even cheaper than that, but we're going to use 5 in this example. So there was a day for $20. I could get, me and 3 of my friends, we could all go to the movies together for $20. Can we go to the movies 4 of us go to the movies for $20 today? No, it's probably more like 60. It's going to be about $15 a ticket to get in. So when I say I want to preserve the purchasing power, the idea is, if I have $20 today and I can buy 4 movie tickets with it, I want to have enough in the account 10 years from now to still buy 4 movie tickets. That means the money has to grow at some point just to keep up and buy the same things. Now, you'll get the idea here. We're not really making progress. We're just kind of maintaining status quo by the preserving. So that brings us to the next underlined word, which is grow. Growing capital is the part where we go beyond just preserving it. And I want to make a distinction here between creating capital or creating wealth and growing wealth. Creating wealth is when you spend less than you make for a very long time and create some excess on the side that you can then use to invest. So the creating capital is something you do by working and earning and spending less than you earn to build this capital over here. Growing it is when you take what you've saved and you invest it so that it can go beyond what you've got on your own. You want it to work for you. In addition to your efforts, you're going to let your money work for you as well. And we're going to put all this together in a portfolio. And a portfolio is nothing more than all the accounts that you have that hold your investments. It might include an IRA, a 401k, your spouse's 401k. It might be just a general account a brokerage account that you have somewhere with one of the large companies. But you put all those together, that's called your portfolio. And you've got parts of it that are preserving, you've got parts of it that are growing, but all together, your ultimate goal is to have enough money when you need it. So think about it. The 2 big questions you have to answer before you start investing is, how much do I need and when do I need it? Because that's going to be your ultimate goal there, is to have what you need at the time you need it. So let's take a look at this diagram. And this is going to give us an idea of what it might look like over your lifetime in this growing and preserving capital. So you notice over here, we start out with the accumulation phase. And this is just like when I started working. I came out of college, I got my first real job, and I started accumulating some assets. I started accumulating some capital that I could invest. And then as we go through life, you come all the way down here, you keep saving and investing, and eventually you get to what we call the distribution phase. And this is when you're actually using what you've saved to accomplish whatever your purpose was. Now, you'll notice these little stair steps down here. Each of these gets a little bit higher, and then it kind of goes back down. The height of each of these bars represents how long until you need the money. So, well, let's look at these first two. The first one is debt payoff, and then we have emergency savings. And if you think about it, when you first get out of school, you first start working, you may have your first car loan that you need to pay off. You've got some emergency savings that you want to build. And these two things, you're not going to necessarily invest the same way that you would for something else, because you need this money to be available when you need it fairly soon. In fact, you may not invest this at all. This may actually stay in cash in the bank, so that you can have it accessible whenever you need it. But then we're going to move out here. The next level is going to be major expenses. These things that are a little bit further out. It might be your kid's college education. Perhaps it's a second home. Maybe it's a big trip that you want to take. But you need a little bit more money for it, and they're a little bit further out over here. So we're going to invest these in a different manner. Now, the tallest one here is what we call long-term. Long-term, the most common one for most people, is retirement. That's usually the biggest thing that most people save for, and it's the one that's the farthest out. You've got longer before you get there and ready to do that. And we're going to invest this in a completely different way because we need more and we need it further out. But you'll notice once we move past retirement, the blocks start getting smaller again. And that's because once you're in retirement, you need to take some of this long-term money and move it down based on, again, when you need it. Maybe there's some things you need for the next 0 to 3 years to actually live off of. This is going to be your income in retirement for the next 2 to 3 years. We're going to invest that in a different way than we might invest what you need from 4 to 9 years. And then we're going to leave the rest of it up here in long term because it's still 10 plus years. Even when I'm in retirement, recognizing that people live to almost 100 now, you can spend quite a few years in this long-term phase. So that's the general idea of how you progress through there. So again, the key thing is to remember we need to know how much we need and when do we need it. And once we filled in those buckets and identified what we need, then we can move into actually investing. And the nice thing is this is not nearly as complicated as you might think. There are really only 2 ways that you can invest money when everything boils down. You can either own something or you can loan money to someone or some place. And in both of these situations, you're getting rewarded for taking your cash, your funds, and either buying something with it or loaning it to someone. And there's risk and rewards with both of these. But these are the really 2 basic ways we invest. Now let's take a look at each of these a little bit more. We're going to start with owning. Now, when we think about what we can own lots of things. We can own a car, we can own some jewelry or some collectibles. We might own our home. We might even own a business. If you can't tell, this is a little donut shop. So we might have a little small business that we own. There's lots of things that we can own. But when we're talking about investing, we're generally talking about owning a stock. And by a stock, we mean that you own a piece of a publicly traded company. Now, you may also hear the term equities used to describe stocks. So keep that in mind. If you hear equities or stocks, those are pretty much interchangeable. But now as a stockholder, you're actually a partial owner of the company. And it's really the same principle as when you own that little donut shop, except that where it's just you and maybe one other person in the donut shop. And it's pretty hard to find a place, if somebody else wants to buy you out, that's a pretty big deal to get somebody to buy you out of your business. But when it comes to large publicly traded companies, there's lots and lots, hundreds and thousands of owners in these large companies. And there's actually a market that you can go to, a fancier version, but it's kind of like your local farmer's market. I can take my stock there, and if I don't want my Amazon stock anymore, I can sell it to somebody else, and I can go over here and I can buy some Google stock. So there is a market where you can easily buy and sell the different companies that you want to own out there, so that it's not like owning your own business. It's the same principle, just a much larger scale. Now, there's a couple of ways to make money when you own a business like that. You can either make it from the dividends, or you can make it from the increase in value of the stock. Let's look at the dividends first. Excuse me. Dividend is when you hold the stock, and because you're a part owner, when they have profits, they're going to share some of those profits with you as an owner. Just to give you a real simple example, it's the same principle. Let's say, excuse me, your daughter and your neighbor's daughter, and it's one of those really hot 95-degree August summer days like we have here in South Carolina, and they're going to have a lemonade stand. So they go out, they do a great booming business with their lemonade stand that day. At the end of the day, they look at all the cash they brought in, and they have a decision to make. How much of it do they want to put back and buy more cups, more sugar, more lemons for the next day so they can make more money? But then what's left over is their profit. And the two little girls get to split that profit. That's their dividend from their hard work from that day and from being an owner in the company. Just like the donut shop. At the end of the year, you're going to put some back into the business, but you're going to take some profits as an owner. And it's exactly the same thing with a very large company. Every year, they're going to decide how much of our profits do we put back into the business to do more business? And then how much of it are we going to declare as a dividend? That's the terminology they use, and send out to the owners of the company. And typically those are paid on a quarterly basis when you start getting dividends. The other way that you can make money is to have an increase in value of the stock. And this is probably what most of us think about. We've got something that we own and we buy it for X dollars, it increases in value, and we sell it for more than we paid for it. And there's lots of things that can affect the price of a stock and help it go up or down. Whether it's the company is doing well, they have increased earnings. They might do well because they have this new product. Let's say a pharmaceutical's got, like in the news lately, a new vaccine coming out, or Apple's got a new iPhone coming out. All those things can help improve the stock price. And sometimes things that are just going on in the general market will also affect their stock price. But let's take a couple of slides and illustrate how this works in practice. So let's assume, and these are all completely made up numbers and prices, but let's assume that you bought 100 shares of XYZ company, and you bought 100 shares back in January of 1980 for $50. So you invested $5,000. And this is some long-term money. You don't need it for a while. So you just let it sit there. We get out to 1985. It's now worth $60 a share. That's nice. I've made $5 a share on what's going on. So, but it's still long-term money. I don't need it. So we wait. And now we hit October of 1987. Now, if any of you remember the stock market back then, that was a very bad month in the stock market. So the price of your stock now went from $60 down to $45. Fortunately, you don't need it, so you don't have to sell it and lose money at this point. You can just keep holding it. But then we get to March of 1990. The price is now $65 a share. And you say, you know what, now I'm ready to spend it on what I was saving it for. So I'm going to sell this stock. And now it's $15 a share more than what I paid for it. So I just made $15 a share, or $1,500 on this stock. But now that's not all I've made, because during that time that I owned it, it was also paying a dividend that we talked about. And in this case, it was paying a 25-cent per share per quarter. So 4 times a year, you were getting 25 cents for every share that you owned. And you've owned it for 41 quarters. So that means you made $10.25 for every share of stock that you owned. So not only did you make the $1,500 from the increase in value, you also made $1,025 from the dividends that you collected over that time period. So that's not a bad option there, to be able to buy stock and benefit from both the dividends and from the increase in value. So those are how stocks work. And that's how you make money from them. But I said the other way to invest is to lend money. And there's lots of ways that we can lend, and what it's called really depends on who you're lending to. If we lend to a person, we call that a loan. I gave my neighbor down the street $50, so I loaned him $50. He'll pay me back sometime. That's how a loan works. Now, if I loan money to the bank, we call that a CD. Now, I'm guessing most of you probably didn't think about having a CD as being loaning money to the bank, but that's really what it is. You're giving them your money so they can use it for something else, to loan out to someone else, or for something they need at the bank, and they're going to pay you an interest in return for loaning it to them. If we loan to a government, we generally call that a bond, maybe a municipal bond, or you may have heard them referred to as bills or note, treasury bills, treasury notes, EE bonds, the treasury, like that. And if we loan to just a corporation, we call that a bond as well. Now, in investing, we're typically dealing with the loans to the government or to the corporations. And just like I mentioned earlier, stocks and equities are interchangeable terms. When we get to bonds, you may also hear those referred to as fixed income. So fixed income, bonds, those are also interchangeable terms. So how do you loan money to a corporation? It's not like they come knocking on your door, or you go offer knocking on their door to give them money. Here's how loaning money to a corporation works. And I'm going to use it as an example. One of our local companies, Duke Energy. It's a large energy company here. There's a large nuclear power facility not far from where we are. And let's say Duke Power wants to do some improvements at their plant, and they're going to have to borrow money to do that. Well, they don't really like the deal the bank's giving them, so they decide they're going to borrow from the public. And so they will take and do what's called a bond issuance. They're going to go to the lawyers and they're going to drop all the paperwork and all the terms, and they're going to go out and say, will you loan me money by buying this bond from me? So Sarah might buy a $1,000 bond from Duke Power at 3% interest. And they tell her, okay, this is great. We're going to pay you 3% interest, and it's going to mature at some point in time. And when it matures, we'll give you your $1,000 back. So they borrow from her directly. And there's a market for that, just like there is for the stocks. If I need my bond sooner than Duke Power's ready to redeem it, then I can go out to the market and we can buy and sell the bonds that we own, just like we do with the stocks. Now, just like with the stocks, there's a couple of ways to make money. There's also some different ways that you can make money with the bonds. The first is the most obvious. It's the interest on the bonds. Like I mentioned, 3% in my example of Sarah getting a Duke Power bond. So whatever the agreed upon rate is, they're going to pay you that interest regularly until they've paid that loan back. And that's how you're going to make monies from the interest. Also, the price of a bond can go up and down, and we'll talk about that a little bit more later, but you've got the two same sort of things going on with bonds that you do with stocks. Now let's talk about the interest first. Interest is pretty straightforward, but the biggest difference with bond interest compared to interest, say, on your car loan or your home mortgage, is that with the corporate bonds, they're only going to be paying this interest to you and not the principal. With your home mortgage, you're paying principal and interest with every payment. That's not how it comes back to you from a corporate bond. They're only going to pay the principal back at the end of the term. So they're just going to pay that interest, usually semi-annually, maybe twice a month. So that $1,000 bond at 3% will pay $30 a year. You'll get two $15 checks during the year to pay their interest on that. Now, bonds usually mature after a stated amount of time, say 10, 15, 20 years. And at the end of that point in time is when you'll get the original principal back. Now, the other way that you can have your investment change value related to bonds is just like with stocks, selling them for more than the original cost. Now, the biggest thing that's going to impact the price of a bond, which is a little bit different than the price of a stock, is going to be changes in interest rates. So let's go back to that example where I said Duke Power had a 3% bond, and let's say Sarah bought that bond, it's $1,000, and they're going to pay that back in 20 years. She's like, that's great. I'm going to collect my 3% interest every year, and everything's rocking along fine until we get to about year 10. And Sarah's like, oh, I need my $1,000. It's time for me to spend it on something that I was saving for. Well, Duke Power is not going to pay back the principal right then because that's not the terms of the agreement. So Sarah's going to have to go to the market and see if someone else, say Sally or Andrea or Joe, wants to buy that bond from her and continue collecting the interest so she can move on and have her principal back. Well, here's where the problem comes in, is she bought that bond at 3%. Well, now interest rates have changed. Duke Power's got new bonds out there that are paying 5%. Doesn't make her bond look very attractive. I don't want hers because it's only paying 3. I want one that's paying 5. Well, the only way I would buy the bond from her is if I gave her less than $1,000 for it, so I still get 5% on my money. So in that example, I would give her $600 for her bond, and so that $30 would still give me 5% on my money. So conversely, if rates had gone down, she might get more than $1,000 for it because it's based on where interest rates are at that time. So it's a little converse to what we mostly think, but the value of a bond actually goes down when interest rates go up, and the value of bonds goes up when interest rates come down. So that's one of the things that throws people a little bit, but it's important to consider when you're looking at your bonds, how that value is going to change over time. So that's how we make money. But you remember at the beginning, I said there's also some risk to investing. So and the reason you get rewarded and get some return is because you took on some risk. So it's important to understand what these risks are. And the first thing I want to point out is every investment can lose value. There is no such thing as a risk-free investment. Even at the bank, if you think about this, how many of you worry about FDIC insurance? That's because you're worried that the bank might go under and you might not get your money back. You feel like there's a risk of even putting your money in the bank. So there's no such thing as a risk-free investment. We're just going to vary on the levels of risk that we take. And it's important to keep that in mind when you go in and start investing. Now, the nice thing is, while they can't be avoided, they can be managed. So after we talk about what some of the risks are, we're going to talk about ways to manage that risk. And this triangle right here is a pretty good example of how we want to talk about risk. And we're going to start with the one in the middle. This big middle triangle is just general market risk. And this is just things that are going on in general within the market. For example, back in 2008, it really didn't matter where you invested. The whole market came down. Everything was affected because of the housing and the financial crisis. We think back to early spring this year, COVID affected everything. It really didn't matter how great a company you were because there were things going on in the market that affected all investments. Now, within that, you may have some that affect certain businesses and industries more than others. Again, in 2008, if you owned a housing company or somebody that was in the housing industry, or if you own bank stock, you probably took a much bigger hit in that industry than you would in some of the other industries at that time. Also, right now, let's go back to COVID. Think about the airlines, think about the cruise lines. Those were industries that were particularly hard hit by what was going on at the time. The other risk that you take on kind of has to do with country and region. Where are the companies located that you're investing in? Let's say, for example, you owned some oil companies. One was in Houston and one was off the Florida coast. And let's say a hurricane came through and it shut down the one in Houston, but it didn't touch the one in Florida. So the one in Houston, that investment's going to go down because they've been put out of business, whereas the other one is still operating just fine. So that's an example of a specific region being impacted differently by what's going on. The other risk is social and political. And this one really can intertwine with all of the others here. COVID, again, is a great example because it was more of the response to it was a political issue that impacted which businesses were open. We talked about the movie industry earlier. So that was kind of an industry as well as a social political risk. Same thing with country and region. Think about Venezuela right now. I don't think I'd want to have some bonds that I was expecting Venezuela to pay back to me. So that's an example of both a social political risk as well as an area risk. So let's look at how all these risks can affect both stocks and bonds, but let's take just a quick minute and look at how it affects them differently. Now, with the stocks, your risks are going to be obviously poor company performance. They get hit by one of these market risks, the oil rig goes out of business. Clearly, they're not going to have the same performance. That's going to affect their ability for their stock price to go up or for them to pay dividends. Stocks are also greatly impacted on a regular basis by things that are affecting the whole market. They're going to go up and down and have a broader range than we're going to see in the bonds in terms of how much they can go up or down based on what's going on in the world and what's hitting the headlines. And how it might impact their particular industry. And the real risk is that you're going to need your cash back, just like we talked about earlier with the bond. There's this risk that when I need to cash it in, that something's going on that has brought that stock price down and I can't get back what I really want from it at that time. That's why it was important in those stair steps we talked about earlier, that we have money set aside in those shorter buckets that aren't going to be going up and down as much. So we can always go to those if there's a problem going on. And then there's also the risk that if you own just a single stock, it could go bankrupt. You could lose your entire investment. A couple of examples of that from history, for those of you going back a little ways, might remember the Enron scandal, huge accounting crisis and scandal. Their stock price went from $90 a share to $1 a share. That's a pretty hefty hit. This year, Pier 1 is down, I think 94% year to date. They're filing bankruptcy. They just weren't able to make it in this retail environment. So those are the kinds of things that can impact. Bankruptcy can have a big impact on your investment in that it could completely go away. Now, these things affect bonds a little bit differently. Again, you've got the risk of bankruptcy because obviously if somebody goes bankrupt, they can't repay the loan that you gave them. But then there's also that risk of the value going up and down based on interest rate changes that I talked about. And to some extent, bonds are also affected by general market changes. I referred to the 2008 crisis earlier. I remember well back in that time, it wasn't just the stocks that got hit. Bonds were down during that time frame as well. So they have the ability to be impacted by it. It's just a little bit different way. The interest rates have a bigger impact on them. And so again, your risk is needing your funds back before the price is where you need it to be. Now, I will say just in general, stocks and bonds are generally considered less risky than stocks, partly because they're not impacted by the general market shifts as much. I mentioned that stocks, we talk about the stock roller coaster. Stocks can go way up, they can go way down, they can go way back up. Over time they work their way up, but it's a bit of a roller coaster ride. Bonds can go up and down as well, just not as far reaching. The ups and downs aren't as steep as you have on the roller coaster with the stocks. The other thing is that in this case of bankruptcy, a bondholder has a preferential status, so to speak, which means that if a company goes under, they've still got to work through, and when they're doing bankruptcy, they're looking for ways to repay their lenders. The owners are out of luck. So if you own the stock, you don't get anything. But if you're one of the bondholders, there's a possibility that you may be able to get something, maybe not your whole investment, but you're going to have a priority position in that bankruptcy. But remember, we said, while risk can't be avoided, they can be managed. So don't let all this scare you. It doesn't mean you shouldn't go into investing. It just means you have to be aware of what's out there and know how to manage it. And that's where we get into what we call diversification, which is a word you probably heard, but all it really means is sort of that old school saying, don't put all your eggs in one basket. That's really the concept of diversification. And it's one of the first things you need to think about when you start investing. And there's layers of diversification. There's different types. And really the first layer of diversification is to make sure that you own more than one stock. We mentioned bankruptcy or how one particular industry could be really hard hit. And I'm going to just use these pencils as an example. So let's say I just own one company and the market's really bad, or they go bankrupt, or something horrible happens. It's really easy to just snap that in half and my investment's gone. And that's all I had. If I had just that one company, it goes under, I have nothing left. I can't write with my pencil. But let's say I had a whole bunch of companies here that I bought. And now something starts happening to one of them. The odds of it being able to break are a lot smaller. I'm not strong enough to break all of these pencils at once because the odds of something happening to all of them at once are much smaller than happening to just one stock. So the idea is, first step in diversification is don't own just one stock. We need to own more than that. But think about it though, that can be a little difficult, especially if I'm back in that accumulation phase. I've not created a lot of wealth. I don't have enough money to go buy a lot of stocks. That's where funds come in. Mutual funds, which is where most people do most of their investing, particularly in your 401ks at work, you're going to have different funds available to you. Mutual funds and exchange-traded funds are simply large combinations of many stocks or bonds selected by a specific fund manager. So let's illustrate this for just a minute. What we have here, all of these individual companies. Now, I could own just one of these or maybe try to buy a couple of them on my own, but I may not have enough money to do all of it. So what happens with a fund is, let's think of it as a big bucket over here. And in this bucket that's got a manager running it, they start buying all of these stocks. They put all of them into this bucket. In fact, they may own up to 100 or 1,500 or even 1,000 stocks in this bucket. And now I can come in as an owner down here, and instead of owning just one of these stocks, I can own a little piece of this bucket. And so now I own little pieces of lots of stocks. And Sarah can come in here and she can own a little piece of this bucket. So now she's got little pieces of lots of stocks. So even if one of them just completely goes away, I've still got all the others in here. So my investment is not impacted nearly as much. So that's the first level of diversification, is we're going to use a fund to spread out and own more stocks than we could buy on our own. Now, the second level of diversification comes into play in this very confusing slide right here. Now, what you find with mutual funds is that mutual funds can own lots of different types of stocks. You might have one that specializes in big US companies. You might have another mutual fund that specializes in really small US companies. Another one buys foreign companies. Another one buys bonds. Another one buys government bonds. Another one might buy foreign bonds. I mean, there's just no end to the combinations of objectives that any individual fund might have. So what we see on this chart right here, and I'm just going to point this out really quick. You don't have to, don't worry if you can't read this. It's intentional. You don't need to. But what each of these colors represents is a different type of fund. So one of them represents large US stocks. One represents small US stocks. All over the place. And what we've got here is each one of these columns is a year. So each column is a year. And it starts down here with the worst performers in that year and goes up to the best performers in that year. And the one thing I tell everybody that we learn from this diagram right here is that we can learn nothing from this diagram right here. There is no rhyme or reason or pattern to what's at the top in any given year. So as we're looking at this, what we realize is, you know what? I don't know what's coming. I don't know what's going to be doing really well next year. So I probably need to have a little bit of everything in my portfolio. Now, what that means is I may not be at the top every year, but then I also shouldn't be at the bottom. I might own some of what's at the bottom, but it's not my whole portfolio. It's not going to pull the whole thing down. And doing all this, there's a great scripture that really talks about this in Ecclesiastes. If you've ever read Ecclesiastes 11:2, it says, invest in 7 ventures, yes, in 8, because you do not know what disaster may come upon the land. And that's really true. We don't know what's coming. We don't know which of these areas is going to be impacted the most. So it's prudent for us to have a little bit of everything. And that's what we call allocation, which is another word you've probably heard when it comes to investing. Strategic allocation. So strategic allocation is nothing more than taking little bits of all of those and putting them together. Now, one of the things we do as we're putting them together is we have to consider how we balance off the risk and the return. Because if you start over here, this is our potential return over here. It goes up to the higher return, and this is risk on the bottom. So as we go out here, the risk gets more. And you'll notice that the very low part, we've got cash, which has very little return, very little risk. But that's not going to get me my goals. That's not going to help me preserve and grow my capital. So I have to start adding in bonds because they've got a little bit more return potential, but they've also got a little bit more risk. And then I can move out here to stocks if I need to get more return to achieve my goals, but it does mean that I'm going to have to take on a little more risk to do it. So what we do, you remember the stair steps in the earlier slide? The things that we need to take less risk with, the things that we need sooner, we're going to weight those more toward bonds and cash. Now, if it's things that we don't need till later, say retirement, then we can come out here to where the stocks are and begin to use those a little bit more. And this is how we put it all together. Sort of the formula for your allocation is to consider your target goal amount, how much you need, your time horizon, how long before you need it, your risk preferences, and put all those together to come up with your allocation. Now, a good illustration to think about this is think about making vegetable soup for a big crowd. And there's a couple of things that you need to know. And the first is, how many people are you going to feed with this pot of soup? That's kind of like your target goal amount. How much soup do I need? How much money do I need for my goal? And then we're going to need, in making that vegetable soup, we're going to need a recipe to tell us what ingredients to put in and also how long it needs to cook. Again, that's kind of our time horizon. When do I have to start this so that I have my soup ready in time when everybody shows up? And then the last thing is I'm going to need to know, and the risk preferences is, do I have anybody coming to my party that I'm feeding with this soup that has allergies or that's a vegetarian? I need to take into consideration some of the specific things to either not put in my soup or add to my soup. So if I have a vegetarian coming, I'm not going to put hamburger meat in my vegetable soup. It's going to be a pure vegetable soup because I need to be sensitive to what's important to them. Now, like I said, all these things need to be taken into consideration. So we have the right amount of soup at the right time that suits everybody. In the investing world, I need to have the right amount of funds at the right time that fit my personal goals. Now, we believe that well-built portfolios use diversified investments to balance these portfolio goals with an investor's emotional needs. Now, I mention emotional needs because that's probably the biggest preference item that we have to factor in as we're building out clients' portfolios. So let's talk a little bit about how those emotions play in. I'm going to actually start over here. Let's pretend this is the stock market. This big roller coaster here is the stock market and prices going up and down. And let's pretend right here, we've got this section right here. This is back in February, March of this year. Everybody remember that? We were coming down and we were down here at the bottom and it did not feel good. Now, what emotions will tell us to do at that point is sell. I'm losing money. I want to get rid of it because I'm afraid of losing it. But we know that over time, the market comes back up. So what happens is if you sell right here, you've lost. In our original example is when that stock went down from 50, the original 50 I bought it for, down to 45. If I'd sold it, I would have lost. But what happens sometimes when people sell, then they kind of start coming back up on this end of it. And they wait and they wait and they wait and they wait and they realize the market's going up, and then they get a really bad case of what we call FOMO, which I learned from my college daughters, a real phrase that's used by lots of people besides us in the investing world. I did not know that until recently. But people really do have a fear of missing out. And so they see things going on in the market and they're like, oh, I need to get in. And what happens is our emotions cause us to buy when it's most expensive and sell when it's at the bottom. And that's the opposite of what we need to be doing. We need to be buying down here and selling up here in order to really make money on our portfolio. You know, it's really interesting. Warren Buffett says the stock market is the only place where nobody wants to buy things when they go on sale. What a person I used to work with before I was able to join Plan First used to have a saying. He always said, you know, it's the strangest thing. My wife has never come home and said, oh, honey, you know that dress that I said was perfect for that event we've got to go to? They've got it on sale at the store. And I asked her, well, did you get it? And she goes, no, I'm going to wait till it goes back up. Nobody does that. But we do it with the market all the time. And that's just something we constantly have to grapple with to make sure that we stay on track with our investments. Now, we've been through, very quickly spent a short amount of time we've been together, but we've talked about stocks and bonds and how you make money with them and where the risks are. So how do you as an investor kind of wrap up? I'm going to go through a checklist of what are the things you need to think about to make sure you're being a wise investor. And the first thing goes all the way back to the beginning. You've got to create some wealth first, which means you need to spend less than you earn on a regular basis so you've got something to invest. You can't be creating debt. That's not going to help you invest. Then we're going to invest your savings that you've created, and we're going to put them in a strategically allocated, diverse portfolio. Just like we talked about with the soup example, we're going to think about when do I need it, which pieces go in bonds, which pieces go in stocks, based on how much I need and when I need it. And we want to make sure that your goals and how we're investing that portfolio and what you want to accomplish with it match up. Like I said, where are we trying to get to and how are we going to make sure that works? It is preferable. I know a lot of people don't like to write down their goals, but it really is preferable if you can write them down, because then you've got something to hold yourself accountable to and compare to and make sure that you're on track. And then the next thing is, once you've let's say you've come up with your plan, you've got the investments going, the job doesn't stop there. You want to review your quarterly statements on a regular basis, and you want to see, is it still allocated right? I'm going to give you a real quick example. I started in this business back in 2001. I had great timing, right? 9/11, tech bubble crash, all that. It was a fun time to be in investing. But what I realized then, I learned this allocation rule very quickly, because we had clients that had come in the door that, say in the late 90s, they started out 50% bonds, 50% stocks, what I call a middle of the road portfolio. That suited their risk tolerance. They were comfortable with that. But when we hit the late 90s and things went haywire, what we found is that the stock piece grew a lot faster than their bond piece. So now, instead of being 50-50, they were more like 75-25. And if they didn't adjust that, and if they didn't bring that back in line, when everything crashed, they took a much bigger hit than they were really prepared for. Now, fortunately, as we work with our clients, one of our jobs is to make sure that doesn't happen to our clients. Is we keep them in those allocations that they're designed to be in. We don't let it get that far out of task. But it's very easy for individuals to get caught up in that fear of missing out. They don't want to sell what's doing good. They want to hang on to it a little longer than they should, and then it ends up hurting them in the end. But you also want to keep an eye, are the fees right? Do they have your contributions and withdrawals right on what's going on? You're going to keep up with that. Do you have the proper beneficiaries listed, so if something happens to you, these investments go where you intend them to go? And then this goes back to that one slide we talked about. Plan for volatility. Expect that the risks are there. Expect that it's going to go up and down, and don't let it catch you off guard and cause it to have you make decisions that you shouldn't. You're going to go back to your plan, you're going to stick with the plan, and you're not going to get caught off guard by the volatility. I want to close with a scripture that I think sums this up perfectly. It's always been my favorite scripture to share when I'm talking about finances. And it's Proverbs 24:3-4. And it says, an enterprise is built by wise planning. It becomes strong through common sense, and it profits wonderfully by staying abreast of the facts. And in my mind, that's exactly what we've been talking about today. You're going to build your portfolio by some wise planning, looking at when you need it and how much you're going to need, balancing out those risks in that strategically diversified portfolio. And you're not going to go You're going to use some common sense when things get a little rough, and you're going to remember what your plan was, and then you're just going to stay on top of it. You're not going to set it and forget it. You're going to pay attention, and it says you're going to profit wonderfully by staying abreast of the facts. So I hope this has been helpful to you. And I think at this point now we're going to take the last 15 minutes of our time together to answer your questions, because that's really what's most important. I could talk all day and tell you lots of things I think are helpful, but I really want to be able to answer the questions that are important to you. So I'm going to ask Sarah to come back up, and we're going to go into our Q&A session. Oops, all the pencils on the floor.
All right. Well, before we transition to our question time, I'd like to say two things. First, thank you, Sherri, for your insight and expertise and sharing that with us. We appreciate you providing this information in such a helpful way. Second, for those of you who are joining us today, you will receive an email later today that includes a survey and a helpful resource. So we look forward to hearing your feedback on the survey. So as we're giving the questions right now, please feel free to enter them in at the bottom of your screen. I am still monitoring the questions and answer portion, so we are still able to take questions while I'm here on stage. The first question that we had for you, Sherri, is what type of investment is an IRA?
Okay, this is a really common question I get a lot. An IRA is actually not an investment in and of itself. It is simply a type of account. So let me illustrate it like this. Think of an umbrella. And the umbrella is over your investments, and it's telling the IRS how to tax this. So this tells them, Mr. IRS agent, whatever I have under this umbrella is not going to be used until I'm in retirement. So I don't have to pay taxes on how it's growing, or even what I first put in, until I take it out in retirement. Now, under that, you can invest it however you want. You can keep it in cash. You can put it in a CD. You can buy a stock with it. You can buy a bond with it. Combination, you can buy mutual funds with this. Whatever you want to do with it. So any of that strategic investment that we talked about, you can actually do with underneath that umbrella. And the IRS looks down and says, okay, it's covered by the umbrella. We're not going to tax it. And then when you get to retirement and you start pulling it out to spend it, that's when the IRS comes in and says, hey, I want my part. That's when they take the taxes on it. So like I said, IRA is not a type of investment. It's a type of account that tells you how it's taxed.
That's a great explanation. Thank you for that. We have another question. This says, I'm an 18-year-old and don't have many expenses. What % of my income should I be investing?
That's a little tricky. What I would say is take a look at building some of those first things that we're talking about. If you don't have many expenses, I'm assuming you probably don't have debt at this point, which is good. So anything you can start building towards your emergency fund, getting that to a place where you're comfortable if something comes up, or looking ahead a few years. I don't know if you're out on your own yet, but building up some reserves for things like, your first place to live, maybe you need a new car. Make sure that's all in place, and those will be more of those just in the bank in a checking account or a savings account type of investment. But if you've got a job and you've got some earned income, this is a great time for you to start funding what's called a Roth IRA, because you don't have a big tax bill. It puts an umbrella over your savings. And as far as a percentage, you really just kind of have to work through the budget. There's not a set amount, but if you could pick something and say, I'm going to do 10%, and honestly, if you start this early and you're saving 10% of your income and you get in that habit and you continue to do that, you're going to be in a great position. So excited to hear an 18-year-old asking that question. So if you can start thinking about it now and putting aside even 10%, that's going to be a phenomenal savings for you down the road.
Thank you. Talking about IRAs, we do have another question.
Okay.
What is the difference between a regular IRA and a Roth IRA?
Okay, great question. Both of those, as I mentioned, are umbrellas. But let's compare the two. Let's put the Roth over here. And traditional is the typical term we use for the other type of IRA. Now, as long as you have earned income every year, the IRS allows you to put up to a certain amount based on your age into these accounts. The biggest difference between the two is that in this traditional IRA, you're going to deduct this on your tax return right now. So you're going to reduce whatever you would typically pay taxes on by whatever you put in the IRA right now. A Roth, on the other hand, is no deduction now. So it's just money that you've got over here. The IRS really doesn't care about it. You're just putting it into the Roth investment account. The difference comes down the road. Now, neither one of these gets taxed on any of the growth along the way. The difference comes in retirement. When you get to retirement and you take the money out of a Roth, you didn't get a deduction here, but now you also don't pay taxes on it when you take it out. A traditional IRA, you pay taxes, and I'm sure you guys are having a great time reading my handwriting on distribution. So the tax situation is the big difference between these two. A great way to think about it is, do you want to pay the tax on your seed? With the Roth, you're paying the tax at the beginning on the amount that you put in, but you don't pay anything on your harvest. Whereas with a traditional IRA, you don't pay taxes at the beginning on the seed, but you do pay taxes on the harvest. So in general, you're going to pay more taxes at the end of the day on your traditional IRA, depending on where your tax brackets are. So the 18-year-old that asked the question earlier, if you wanted to start saving for retirement and wanted to start investing, a Roth IRA is going to be a great place for you to start, because it's not very painful for you to pay taxes on that now because your tax bracket's not very high. But then that's going to grow throughout your lifetime with no taxes when it comes out at the end.
Thank you. So I'm actually going to kind of combine these two questions.
Okay.
So the question is, how does a person who comes into an inheritance best plan for investments? And what are some things to avoid?
Okay. I'm going to try to make this educational, because this really does depend on your personal situation a lot in terms of what you're going to do with it. I will mention that when you look, let me erase this for a second. And I will preface my comments by saying this is under current law. Things may change, but under current law, one of the first things that you want to do in terms of just assessing what tax situation you might be in is to look at what types of things you inherited. If you inherited an annuity, or you inherited an IRA, those things will still have taxes due on them, just like they would for the person that owned them originally. So you're still responsible for the taxes that are associated with those. If it's other types of assets, just a regular checking account or investment account, or if it's a house, the government right now gives what we call a step up in basis, which means you sort of step in where everything is worth right now. Your tax burden is only going to be on what it grows from the date of death from the person you inherited it from forward. So you don't have as much as the tax burden. So it's important to, one, first look and see, what did I inherit? So you understand your tax situation. Beyond that, investing that is going to go back to setting your own personal goals, doing those stair steps that we talked about at the very beginning. What do I need? Might I need to use from this to spend for myself and my goals in the next 2 to 3 years? And you're going to put that pretty conservative. Then you're going to look and say, what might I need to use from this in the next 4 to 9 years? Add some bonds to that. Might be a little more, take a little more risk, but not too much. And then things that you say, of this inheritance, I want it to be for my retirement, or I want it to be for something I'm not going to do for another 10 years, then you would invest it more aggressively, or more like we would for the long-term assets like retirement. There's not a set answer for everybody. It really does involve sitting down and looking at, and oftentimes when we have clients come in that have had inheritance, part of what they're looking at is they're wanting to give with that. They have some charitable goals and they're wanting to do some gifting with that. And again, there's some techniques that you can do that are more tax advantaged than others with the gifting part of it. But that's also a really important part to consider is, what do I want to gift? What do I need to live on? What do I want to use for maybe for my children or grandchildren? How do you want to use it? And that will direct how you want to invest it.
That's great. Thank you so much. Okay, so another question that we have is, being self-employed, what is the best way to plan for retirement?
Okay. I used to work with a lot of self-employed people before I joined Plan First. And fortunately, There are some good ways, some plans out there that are available to you as a self-employed person. Part of it is going to depend whether or not you have employees or not, because some of the plans that you can do that'll look like a 401k to your employees and to you may require you to do more as a benefit to your employees in terms of match and those kind of things. At a minimum, if it's just you and you're not sure how much you want to do, there's something called a SEP IRA, which you can look this up online or contact a Ronald Blue advisor anywhere. They'll walk you through it. But if it's just a single person, self-employed, a good place to start is what's called a self-employed IRA. And it's essentially a profit sharing plan for your business. And you can fund it up until the last filing date of your tax return, so you really know how your business did that year. And then there's a formula that takes into consideration your Social Security payment, but it'll calculate roughly 20 to 25% of what you earned that you could put in as a maximum. You don't have to do that full amount. You kind of look at your own cash flow and see, but you can open that account up. You can invest it long-term, like we were talking about for retirement. But that's a really good in terms of managing your tax burden as a self-employed person. There's some other things out there, simple IRAs, and there's actually some simple 401ks that can be set up. There's a lot of things out there, but I would encourage you, if you're not doing anything, at least start with a SEP IRA and then get in touch with either your tax preparer or Ronald Blue advisor, and they can help you look at some of the other options that are available for you.
Okay, great. Going back to investments, actually,
Okay.
The question is, what do the markets represent? For example, Dow Jones, S&P 500, et cetera.
Okay, that's a great question because, again, we get that a lot because that's what's all over the news. Everybody's always talking about, the market's up. Well, what are they? Which market? There's lots of markets. There's a market for bonds. There's a market for stocks. There's a market for big company stocks and small company stocks. Well, what you typically see on the news, the Dow Jones is just a measure of 30 large companies, large US companies. And it was designed to represent as much as possible kind of the general makeup of the industries that are involved in our general market here in the US, but it is only 30 companies. So it's a pretty narrow target and it's just large US companies. So very often it can be confusing. You're watching the market, as in the Dow, go up and down, while your portfolio might be doing something different because you don't have just large US companies in your portfolio. You remember, we're going to allocate. We're going to have foreign companies. We're going to have bonds. We're going to have small company stocks. And none of those are represented by the Dow. But that is what's on the news every day. And then the S&P 500 is the other one that you're going to hear about. And it's bigger. It's got 500 companies instead of 30. But it's still a very small pool, and it's all large US companies. Bit of trivia. I did just learn this last day. Talking about the Dow, they changed the companies that are in that periodically. And as a matter of fact, I think back in August, they swapped out 3 of the companies that were in there for 3 new companies. I think, was it Procter & Gamble dropped out? No, Procter. Anyway, there's only one company in the, it might have been, I'm sorry, I just cannot remember which 3 they took out. They took out 3, added 3 new ones. And that's been happening ever since this index was started back in the 1930s. It's consistently changed over the years. And it's a really interesting thing. If you want to just Google something that's fun to look at, look and see who's currently in the Dow and how long they've been there. There's only one company in there that's been there since the 1930s. All of the others, and I want to say it was Procter & Gamble, maybe? Does anybody, I'm blanking out, y'all, I apologize, but I want to say it's Procter & Gamble, but look it up. It's really interesting that only one has made it through for the entire time since 1930.
That is really interesting. Yeah. Thank you for that. So this may be our last question, okay, depending on the explanation.
Okay.
The question's kind of broad, actually. Okay. But basically, it's what about investing in real estate?
Okay. There's a couple of ways to invest in real estate, and obviously you can't, some people love to invest in real estate personally. They like to go out and buy houses and they like to get the rental income. It's still one of the ways of investing is owning. But you can also do investing in real estate through mutual funds that we talked about. There's actually mutual funds that will go out and buy companies that are in the real estate industry. And you can do it that way. So it's a good diversifier, just like everything else. Just depends on how you want to go about doing it. And I do realize that we're right here at the end of time. Do we have any more questions, or is that going to wrap us up for the day?
I don't know if we have time for this. It kind of goes back to what we first talked about, but is it better to invest in an IRA or a 401k?
Well, I will say this again, just being sensitive to time because we want to honor everybody that signed up that we told them we'd be done at 2:30. So I'll answer this very quickly and then turn it back to you, Sarah. If you have an employer with a 401k that matches the money, always start there because nobody else is going to give you free money. So you can't get the match in your IRA. So start with your 401k and then go to the other options if available. So
Okay.
I will turn it back to you now that
Thank
we're
you.
at the
And
end of
actually,
our
I
time.
found out the answer to the original Dow company. It's General Electric.
That's not the one I was, okay.
That's what someone brought in.
Okay, that might have been one of the, okay, they're still in there, okay.
They're still in there.
Okay, awesome.
All right, well, thank you so much. So that question concludes our question and answer time for our webinar. Thank you so much for joining us, and we hope that this information was beneficial to you. Again, thank you so much, Sherri, for just coming in here and just giving us this information. We really appreciate it. And we hope you guys have a great afternoon and a blessed day.